Why do some people retire with financial freedom, while other people retire and they struggle and scrape just to get by? I asked myself that question back in 2010. I've learned a lot, and I am here to share with y'all what I've learned. Welcome to the Financial Fountain of Freedom webinar series, where I help investors achieve financial freedom by creating streams of tax smart income while growing equity for future generations. My name is Brett N. Reed, and I would like to encourage you to be good. And by good, I mean get out of debt, achieve your financial dreams, and give generously to your community. Today, we're going to talk about how to build and test a trading strategy. I've had lots of people reach out to me this last week and say, "Hey, Brad, I got a question about this trade." And my first question will always be, what does your trading strategy say? And from here on out, if you say, I don't have a trading strategy, the first time I'm going to find you $100. And the second time, it's $1,000. And after the third time, well, I hope you keep asking me. No, I'm just kidding. Um, Folks, your trading strategy, your trading rules, it's the basis of everything. If you don't have a trading strategy, the heck are you doing? Um, you, it, it's like saying, I don't want to be successful if you don't have a trading strategy. Next time we'll talk about indicators. Then I'm jumping into options. And then after that, I'm going to jump into Greeks. And then we're going to talk about portfolio construction. I'm like, am I saying that right? It's late at night here. So we are staring at the end, which means I'm going to go faster. I got a special surprise coming up. So don't fall asleep just yet. Folks, I have a dream to create a business that is a four-tier business. To begin with, how to get out of debt. I will not be charging for that. That will be free because I think everyone should get out of debt, especially if you have access to high-speed internet and videos such as this. Financial freedom awaits. Get out of debt. Second, I want to talk about mindset. If you read books about investing, nearly half the books are about mindset. Recently, my wife and I were watching this. It was a YouTube video, but it was a recording of a podcast. And this may be a little bit cruel, so don't get upset. I'm just the messenger. I'm not the torturer. What's up, Steven? Thanks for being here, buddy. But what they did is they took some kittens, newborn kittens, and they put them in a dark environment. And one set of kittens they would only expose to things that had horizontal lines, no vertical lines. And with the other group of kittens, they only exposed them to objects and shapes that had vertical lines, no horizontal lines. And after a series of time had passed, then they put the kittens out into a natural environment. And the kittens that only saw horizontal lines, they could never see vertical lines. They never learned how to see vertical lines. And they would bump into like table legs and chair legs because their brain would not process vertical lines. And the same thing for the kittens that only saw vertical lines, they couldn't process horizontal lines. So what does this mean to us as we're going forward, as we're learning about trading and investing? What are the things that we're blind to? How have we been conditioned as growing up that are our blind spots? What have we been told about our that we can and cannot have based on our gender, based on our race, based on our skin color, based on where we were born, based on when we were born, based on our parents, based on our grandparents? I'm sure all of us were taught that we can and cannot have certain things, be certain things, live certain lifestyles because of fill in the blank. And so the mindset piece is all about learning and unlearning on our true potential and then realizing that potential. So stage three is invest for success. That means how to learn to invest for yourself, build a business, build multiple streams of income. Buy a business is a much faster way than building a business. My wife and I actually talked about that on a Instagram live on Monday at 11 a.m. Eastern time. And then stage four is once you are financially free, how do you stay financially free? How do you achieve happiness? Most people will tell you that happiness does not come from having a lot of money, but a lot of people that give generously to their community, they feel that happiness and sense of fulfillment. So once you reach the top of a mountain where you are financially free, how do you keep it? How do you live happily and generously? And how do you pass it on to your community? All right. After I said that, none of this is financial advice. I feel like there should be a gong sound or the wah wah sound. This presentation is for education and hopefully entertainment only. Should you need or want personalized financial advice, seek someone that is confident and licensed, hopefully, in your area. Bijan has talked about an offer, but nothing in this webinar or in the chat pane will document that offer. That offer and all offers will be outlined with a PPM, and that will be what constitutes the offer. All right, we will be talking about investing in strategies. All of these strategies have risk associated with them, especially if you don't do it correctly. But even if you do it correctly, you could lose a significant amount of money or all of it. All right, so what is the set of rules? What is the process? Number one, work on your mindset. Your money mindset will determine your financial future. Your money mindset very likely determines your financial present. So if you want a financial future that is different than your financial present, you need to change your money mindset because no strategy is going to work if your mindset is messed up. All right, need to calculate your desired rate of return. There is the website where you can go get an inflation adjusted retirement calculator so you can determine what rate of return you need. Structure a great portfolio that is diversified, non-correlated with asymmetric risk reward. These are the Dalio guidelines. Thank you, Bijan. Bijan is sharing the link to the inflation adjusted retirement calculator in the chat pane. Check that out. Peter Maluk reports that his highest net worth individuals have the majority of their wealth in real estate, followed then by private equity, and public equities like stocks make up only about 15% of high net worth individuals' portfolio, followed by energy and then alternatives. So when my wife and I learned this, I think she turned to me and said, how much are we in the stock market? And I was like, yeah, we're about 90% in the stock market and about 10% in alternatives. And so now we're about 15% in public equities, 60% in real estate. I don't remember the rest off the top of my head. Also, structure a portfolio that serves your need for cash on cash or equity growth, depending on your needs and whether you are in retirement or not in retirement. Indomitable Horizons Fund has investments now. Spoiler alert, it is a portfolio of real estate. This portfolio is diversified, is non-correlated with the other markets, and it does have asymmetric risk reward. Not saying it's right for everyone. It does have good cash on cash and equity growth. It is for accredited investors only, but that's why it is my second largest holding. Okay, folks, as we go forward, never forget we will learn 10% by reading and listening. We will learn 30% by discussing with others and 60% by actually doing this. So when you hear a strategy or something that I talk about here, realize you're only getting about 10% of the skill that you need. You must discuss it and you must practice it in order for you to develop that skill into something that will make you money. All right, the big long series here is mortgage tips and tricks because your house is the biggest thing most people spend their money on. We're in the middle of stock market education. Next, probably in July, will be multifamily knowledge. And then that'll be a good, healthy series. Maybe October, November, we'll get into private equity and energy. All right, schedule alert, schedule change. Coming up on June 12 to 14, there's a webinar that I have taken 2 or 3 times that really puts a lot of these stock trading concepts together. Actually, Bijan found out that it's happening again. And so there's been a group of us that are talking about we're going to go see it, watch it together. So block your calendar now if you're interested in one webinar where it takes a lot of the stock trading concepts that I have talked about and will be talking about over the next several weeks and puts it all together with teaching, with talking, with practicing, right? Remember those three things that I said? You got to listen, you got to discuss with others, and you have to practice. Yeah, we get to do all of that. And Bijan and I are talking about how we can put like a little group together and we all go do this together. So if that's remotely of interest, block your calendar now. I am reaching out to that group. I have reached out to that group. I've not heard a response yet, but I'm trying to figure out how we can all get together or get a preferred rate, something like that. So working on that. Stay tuned to emails and come to future sessions. All right, the current schedule puts our last module on June 17. So in order to get all of this content in before that webinar, I am going to schedule a special session on June 10th here. So I will see if I can add it to this webinar chain. If not, I'll add another, a new link. But watch out for that one on June 10th. And yeah, it's just so we can all be ready for June 12 to 14. Okay. So again, the idea is to attend 12 to 14 as a group. And then June 17 is a review of all the stock trading awesomeness before we move into multifamily. All right, the goal is to master these things. It will change everything. And almost all of these will be discussed at the June 12, 13, and 14 webinar. Make money when the stock is going down. You can do that by selling short or buying long puts. Set your order, set your entry, your stop order, and your exit all at once and walk away if you want to. Order triggers, order cancels order. We've already talked about that. How to buy insurance on stocks. I've had a lot of people reach out to me and say, Brad, skip ahead. Tell me how to do that. How can you earn income from a stock while you are waiting for it to hit your buy price? That means you don't own it, but you're still getting paid. How cool is that? Or while you're waiting to sell your stocks, get paid every month. Okay, sell covered calls. You either get to sell it at your target or you receive a premium. Actually, it's both, right? You either receive a premium while you're waiting or you receive a premium and you get to sell at your target. How to lock in your gains. If you're winning on something and you don't want to lose, you can lock it in. And then we'll get into some much more advanced strategies where you must know Greeks like alpha, delta especially is a helpful one, but alpha and delta, theta and vega will come into play in these. But if you have all those and you know how to look at them and study them, you can place a trade that will make move as long as the stock moves up or down. You don't care which. And then if you think a stock is going to go sideways, then there's a trade you can place to make money on that one as well. This is the point so that we can make money if a stock is going up, if it's going down, if it's going sideways. If we don't know if it's going up or down, we make money. That's the plan. All right, ETFs are powerful to know for any trader. Is basically just a basket of stocks that trade on the exchange, like one ticker. Market ETFs are the most common. If you just want the S&P 500 performance, you can just buy a share of ticker SPY. DIA follows the Dow Jones, QQQ follows the entire NASDAQ, IWM follows the Russell 2000. There's several hundred ETFs. You can find leveraged ETFs that'll move faster than the underlying ticker. You can find inverse ETFs. I believe it was last time or time before we talked about how there's a ETF that follows Nancy Pelosi. So if you want to trade like Nancy Pelosi does, you can buy this ETF. And if you want to do the exact opposite of what Kramer does, there's an ETF that is an inverse Kramer fund. Lots of different ETFs. Enjoy playing. Another type of ETF that I like are sector ETFs. It's a group of stocks that follows an entire technology, healthcare, energy, financials, et cetera, but an entire sector. So if you think some current event like the war in Iran is going to affect the energy sector, maybe you don't know exactly which company, So you can just buy one or several shares of an energy ETF, and then you get a little bit of each of it. Maybe you think AI and robots are going to be bullish for technology for the next 5 years. In that case, you could buy some shares of technology sector ETFs. All right, key terms, analyst. If you haven't gotten this from me yet, let me say it a different way. The stylist at Supercuts has a more rigorous training and certification program than the stock analyst that publishes on Facebook. Okay. The stylist at Supercuts is more regulated by the government than these people that write articles about what stocks to buy and sell. These analysts can be, sometimes are, complete idiots. They can be writing articles just to make you click on it because they get paid when you click on it. They don't have to be right. They don't care if they're right or wrong. Okay, I probably should move on and calm down just a little bit. A brokerage is a company that executes orders on your behalf. I like Thinkorswim. It's a Schwab product. Memorize that referral code and type it in letter by letter. Just kidding. It'll be in the description of this YouTube video. It'll also come in the email that is a follow-up of this. It'll come tomorrow or Friday. An exchange is where stocks are bought or sold. In the US, we have the New York Stock Exchange, NYSE. We have NASDAQ. For options, we have the Chicago Board of Options Exchange. And whatever country you are in or near, there will be one that works for you. Feels like I should have the Toronto Exchange. If we have any Canadian brothers and sisters in the crowd, you trade on the Toronto Exchange. All right, this one's important. A market maker is the person or entity. That's right. There are some times where you still get to do your market making by a person that helps you execute your trade. All right, so the market maker is the between person. When a seller sells shares, their shares go to the market maker. Then the market transfers those shares to the buyer. The buyer pays the price called the ask, and the seller receives the price called the bid. The bid is almost always lower than the ask, and the difference between the bid and the ask is what the market maker receives as profit. You may have heard something called the bid ask spread. That is different from big ask spread, as we say sometimes in the South. Bid ask spread. For low volume stocks and for options, especially after hours, that bid ask spread can get very large. So pay attention and be sure you're getting a good fill. All right, we talked about the Shiller PE ratio and the Buffett indicator as measures of is the market a good value or not. And let's see. Go take a look at this. Come on, computer, you can do it. There we go. We have now even more officially reached the second most overpriced in the history of the stock market since Jesus died on the cross. There are some people that don't like Shiller PE ratio. I think we are insanely overpriced. It is basically the value of the stock market divided by the earnings of the companies that make up the stock market and what you are paying for every dollar of earnings. It is the second most overpriced we've ever been in the history of history. Spoiler alert, I am not super bullish on the stock market. Doesn't mean it can't go up, doesn't mean it won't go up. It just means I think it's overvalued. I have started receiving articles about big investors that are in a lot of cash. Warren Buffett, you can go check out the Buffett indicator. It'll tell you something very similar to the Shiller PE ratio. But I heard Buffett is now $400 billion in cash. Signals Warren Buffett's waiting for a downturn. All right, review. There's this thing called support. It's where stocks tend to bounce. When stocks bounce off the support, they tend to go to resistance. If they get rejected by resistance, they tend to go back to support. They go back and forth from support to resistance until they break through. If they break through resistance, old resistance tends to become new support. If support breaks down, old support tends to become new resistance. Order types, these are really, really important. This is the third time we're talking about these, so I'm going to go a little bit faster. If you're watching this video on YouTube, hit pause. Take this test yourself. You must get a 100. All right. If I want to sell at this price or higher, what order type is that? Oh, thank you. Steven says, I'm not sharing. Y'all had to be looking at my face. Yeah, it's almost like I've used Zoom before in the last 6 years. All right, there's support. If it bounces off support, it goes to resistance. If it gets rejected at resistance, it goes back to support. If it breaks through, old resistance now becomes new support. The reason I'm going fast for y'all that are new is that this has been covered in the last 2, sometimes 3 episodes. If it breaks through support, it old support now typically becomes new resistance. All right, if I want to sell at this price or higher, it's a sell limit. If I don't want to buy until it breaks through this resistance, and then I wish to get filled at the next market price, that's called a buy stop market. If I don't want to sell until it gets down to this red line, and then I will sell at the next market price, it's called a sell stop market. Number 4 down here, if I want to buy at this price or lower, that's a buy limit. This green line here, if I don't want to sell until it breaks down this support, that should say support. If I don't want to sell until it breaks down this support, which I hope will become new resistance, that is a sell stop market. If I don't want to buy until it breaks above this red line as resistance, that is a buy stop market. Let's go again. If I want to sell at this price or higher, that is a sell limit. If it breaks through this old resistance and I want to buy on the pullback, and I want to buy if it pulls back to this green line or lower, that's a buy limit. If I want to sell, if it breaks this red line support, that is a sell stop market. Number 4 down here on the bottom right, if I want to buy at this price or lower, that is still a buy limit. If it breaks through this old support and I want to sell to enter as it retests old support as new resistance, and I want to sell at this price or higher, that's a sell limit. And if it breaks through this red line resistance up here, I want to buy at the next market order to close, that's a buy stop market. Okay, if you're not good at those, get good at those. Back up the video and watch it again. There's something called a trailing stop where you can do this manually, the way I like to do it, or you can set it in your broker and it will automatically increase your protective stop based on a raw dollar amount from the most recent price action or a percentage. So if you enter down here, when it made this high, notice it locks in the stop price. As the stock price pulls back, it does not lower your stop. Your stop never lowers, it only increases. And it increases as the stock makes new highs. So you can trail your stop, and the idea is that you can set it and forget it, and eventually you will get trailed out. You will get trailed out at some point. Hopefully it's for a win. Okay, we also talked about candles. These are originated as Japanese rice candles in the 1880s, 1890s. They use white and black. If your trading platform shows good visuals with white candles for bullish and black candles for bearish, I highly recommend those because I like using colors for different things than bullish and bearish. Traditionally, our minds are conditioned that red is bad, but bearish candles can be a good signal and something fun to trade. So whether it's a bullish candle or if it's a bullish candle, whether it's white or green, the bottom of the candle is the open. The top of the body of the candle is the close. And the top of the wick is the high of that time period. The bottom of the wick is the low. For a bearish candle, whether it is black or red, the top of the body of the candle is the open. The bottom of the candle is the close. And then the upper wick marks the high of that trading period, and the lower wick marks the low of that trading period. Whether this trading period is a day, a week, a month, a minute, whatever. The wicks can be revealing. Long upper wicks show a reversal happened during the time period. Tiny wicks indicate that there was an overwhelming force one direction or another. And tiny, tiny bodies indicate that there was a battleground with the bulls and the bears. Neither side won, but what will happen next? All right. A while back, last time I said, hey, if y'all see a wedge, text me. And Sam did exactly that. So Sam, thank you. So Sam found this on Schlumberger. Yes, I know it's pronounced Schlumberger, but it's much more fun to call it Schlumberger. Um, and yeah, a rising wedge. No, I have this stretched out, really more traditional look like that for a wedge. But a rising wedge like this is typically a bearish trade. And so when she sent me this signal, I pulled up my chart and you can't really see it there. I have an entry right below the pink line here, the bottom of the trade, sorry, the bottom of the wedge to sell stop market. And sorry, I did a sell stop limit, a little bit more advanced, know what you're doing. But I'm counting on this right here being some flavor of an evening star reversal at resistance. And that was Monday. That's the Tuesday candle. Love the bulls coming in here because if it does go down, they will be trapped. And today I got triggered in. The SPY had a tremendous gap up and a bullish push today, and this thing was able to go against the market. 80% of stocks move with the market. So my entry is this green line down here at 55.16. The top, my protective stop is up here at 57.31, and my target's at 50.29. If you want to watch ticker SLB and see how I do, I did do this with real money because I told Sam that I would. So Sam, thanks for sending me the ascending wedge. I traded it and I did get filled. So if it loses, Sam, it's completely my fault. I take responsibility for my trades. All right, there we go. Thank you, Sam. All right, we're talking about a trading plan. And a trading plan is a set of rules that you follow before, during, and after every trade. I'm going to say that again. Before and after, there are rules that you follow, not just during a plan. The reason you need a plan is because a plan removes emotion. When you lack emotion, you can be logical. And when you're logical, you can write up rules, you can test the rules, and you know if you follow the rules based on previous history, what your expectation is for each trade. But when you are in a trade, you are either fearful or hopeful, pretty much without exception. And it is very difficult to make logical decisions when you're hopeful or fearful. So you make your rules, you make your decisions before you get into the trade. And then while you are in the trade, you follow the rules. How many of y'all have been in a trade and it's going up, it's winning, and you're like, oh, I'm winning. I think this is going to go on forever. It will never go down because it's going up. And similarly, if it's going against you, You think, oh, it's got to come back. It always comes back. And I know someone that was in a trade for 10 years and broke even and was happy about it. I would not be happy if my 10-year profit was zero. So, how do you make a trading plan? You need to name the strategy. You need to describe what market conditions will work. When do you use this strategy? You need to write the rules for your entry. Things like when I see a double bottom at support, when I see a bullish engulfing candle at support, I will enter. If I see a head and shoulders at resistance, I will look for a bearish trade. Spoiler alert, when Brad sees an ascending wedge that reaches resistance, Brad trades that thing bearish. Where does your protective stop go? Write it out. Where does your target go? Write it out. I'm doing a 2-hour trade on this one. Log everything before you get triggered in. Once you are in, look at your rules for when you can tighten the stop. Write out rules for when you can lower the target. Write out rules for when do you give yourself permission to exit early. Maybe it's a day trade and it's moving in your favor, but you got about 15 more minutes in the session, and you know from experience that the market tends to reverse in the last 15 minutes. You want out. Or maybe you're in a swing trade, a longer term trade, and earnings are coming up. It's close to your target, or maybe it's close to your protective stop, and earnings are coming up, and you're worried that this thing may gap over your stop on earnings. So give yourself a rule on when you can exit early. After the trade, log everything, your exit price, the resulting R. Write out what happened. Write what you are feeling. Because it's amazing when you've got 100, 200, 1,000 trades, and you go back and you notice how your feelings affect your profitability. Okay, now that you know what is in a trading plan, I want y'all to think about which of these types of patterns I've been talking to you about for many, many weeks now, which of these really resonate with you? Because maybe that's becoming the beginning of your trading plan. In an uptrend, look for 3 consecutive lows in a line. Connect those lows with a line, make a parallel line, call that resistance. Buy low, sell high. Write rules for where you're going to buy low. How low does it have to come to your support and resistance? Spoiler alert, I usually put my entry about 20% above support, and I put my target about 20% below resistance. Buy low, sell high, buy low, sell high, buy low, write it out. Would you have gotten stopped out here? Where does your stop go? Does your stop go just a few pennies below the trend line? Or with this 100 simple moving average in here, would you have put your stop below the 100 simple moving average? And you would not have gotten stopped out here, but you would have gotten to leg in again, and then you double up there as it approaches resistance. What are your rules? What would you have drawn? Do you want to trade bearish? Are you interested in trading bearish? Well, if you want to see a downtrend, you look for 3 consecutive lower highs where you can draw a straight line, do the parallel line, and then where are you going to enter where you can sell high and buy low? Sell high. Oh, would you have gotten stopped out on that trade? I probably would have, but follow your rules. It's better to lose small than lose big. The whole way we win in any kind of investing is asymmetric risk reward. Win big, lose small. Sell high, buy low, sell high, buy low, or sell high, buy low, sell high, buy low. Rinse, repeat. If it's going sideways and you're in what we typically call a channel, draw your support, draw your resistance, write out your rules. Buy low, sell high, buy low, sell high. Now that you know how to trade bearish, maybe you see this right here. You say, oh, there's a double top. I like double tops at resistance. I'm going to sell high and buy low. And then you see this bearish engulfing candle and you want to sell there. Maybe you would have gotten stopped out there. Maybe you would have ridden through it. You see a doji at resistance. You see another evening star reversal and you want to sell short there. And you come up here, you see these two dojis that we just talked about, right at resistance. And that's kind of like a four candle uh, evening star reversal. Maybe you call that a double top, but if you sell high, maybe you don't have any of these candle patterns. Maybe you just say, Brad, I don't care about that. It's at resistance. I'm selling short and I'm buying low. Go for it. This looks like a four candle evening star reversal, or you just say it's coming into resistance. I'm going to sell on the breakdown and I'm going to buy those. Do you like hammer candles at support? Do you like shooting stars at resistance? Do you like doji candles found at support or resistance? Do those make sense to you? And you want to put your entry around those candles? Go for it. Do you like bullish engulfing candles? Do you like bearish engulfing candles? I don't. My eyes don't see those as well as they do the hammers and the shooting stars. Morning star reversals, I like. Evening star reversals, I like. But really, double tops and double bottoms are my favorite. Just because it's my favorite, that's what my eyes like. What do your eyes like? To me, a head and shoulders and an inverted head and shoulders are just a special flavor of a double top and a double bottom. I love wedges. I love them. My eyeballs don't always find them until after they break. Continuation patterns, I typically don't like trading continuation patterns. I like reversal patterns. But what do you like? What does your trading plan say to do? Rest after battle, very special, very powerful continuation pattern. I do like triangles, especially when I'm doing day trades. Those are the funnest. They're kind of a special flavor of double bottom. Excuse me, this would be a double bottom over here. And the resistance line here is just the neckline, or this may be a triple bottom with higher lows. This one over here looks like that's a triple top with the support at the neckline. Maybe your eyes see a double top. I'm not going to argue with you. And then some people love trading gaps. Gaps are rare on most tickers, and it indicates an overwhelming uh, change in the sentiment, right? We were going up and then decided, hey, we're going to go up a whole lot faster. Gaps tend to continue, but some of them retest first. A bullish candle that gaps up or a bearish candle that gaps down, we call that a retest gap. Why does it retest? Because there's people that wake up one day like, holy smokes, I'm way more profitable than I thought. When people are way more profitable than they expected, they close. And if you have a bullish trade and you're way more profitable, you sell to close. And that selling causes the pullback, causes a retest. You should expect a bounce. On a gap and go, it's different. It's when you have a bullish candle that gaps down or a bearish candle that gaps up. And in this case, there's nobody profitable. Everybody's losing money. So the bulls over here are losing money with this gap down. They tend to sell. Bearish traders see the gap. They want to enter. So the bullish traders are selling to exit. The bearish traders are selling to enter. There's a whole lot of selling going on. Ride that thing down. If you have a bullish gap and go, you have a bearish candle that gaps up. The bearish traders are buying to close. The bullish traders are buying to enter. There's a whole lot of buying going on. I love me some gap and goes. There is a strategy called the three arrows rule. This will be discussed in massive detail on June 12, 13, and 14. So find your friends and tell them, hey, we're all going to a trading seminar online. It is online. You don't have to travel anywhere, but we're all going on June 12, 13, and 14. You want me to just show you? Someone type in your favorite ticker in the chat pane. All right, this is the three arrows rule. And you can put I guess it's a macro into Thinkorswim that'll draw an arrow when you get the when you get your signal. So the signal up top is a close on or above the 10 simple moving average. If you get a close below it, you sell. If you get a close above it, you buy. Down here's the MACD. This is an indicator we'll talk about next time. If it crosses from below to above, you buy. If it crosses from above to below, you sell. Down here is the stochastics. If you get a turn down, you sell. If you get a turn up, you buy. Now, the stochastic doesn't always give you the arrow when it turns up. You can see right around in here, it turned up and there was no green arrow. But when you get three arrows in a row, all going the same way, you buy or you sell, depending on what it says. So for instance, right here, what date is this? May, I don't know what year I'm in. But on May of this year, there was a close above the 10 moving average. Looks like right at about that time, you got an upturn in the stochastic. So that's two arrows, but you didn't get the third one until, oh, this is 2020. So July of 2020 would have been the entry. And the sell wouldn't have been till way over here because you got to close below the 10 moving average. You got a cross above to below the MACD, and you got a downturn on stochastic. So you got three sell signals in a row. Sometimes you get one buy signal, then a sell signal. You don't do anything. But this is called the three arrows rule. You can search it. It is public. You can also do it on the daily chart. You don't have to do monthly. Okay. I didn't see any tickers in the chat pane, so I'm just going to go on. I am running a little bit behind schedule. I got to get faster at that review, but man, if there's no review. Review is important. Okay, the three arrows rule does not use a protective stop or target. So if that drives you nuts like it does me, don't do it or do your own. Yeah, okay. So if you want to hit pause and write all these out, you may, or Google it. It's Phil Town, Rule One Investing. And again, if you come to that webinar, they'll go into this in detail. Log everything and follow the plan. All right. So what if the strategy is missing and do you even need to improve it? I have had conversations with traders over the last 2 weeks and they say, look, this is a strategy I got. Here's how I have tweaked it and it's not working. Sometimes you don't have to tweak it. Okay. I know many a trader that has been trying to make it rich in the market for 20 or 30 years and they're about break even. I do not know many people that make wealth in the market. It's a great way to grow wealth, but I don't know many people that make wealth. I do know lots of people that post things on social media and Twitter. And I also know that behind the scenes, those people can have 20, 30, 40 different accounts. And the one that they show you that day may be different than the winning trade that they did the next day or the winning trade that they had before that. I know someone who is a massive influencer and they go around, they teach stock trading webinars and seminars. And they gambled. They took all their money, they put it in on one ticker, and it went nuts. It was a very small, unknown ticker at the time and made like 400% on their life savings in about 3 years. Uh, I don't call that trading. I call that gambling. If they had lost all of their money, they would be flat broke. But yet they are teaching other people how to do something that is not how they made their money. I can go on and on about all of the tips and tricks that I know these professionals use. Um, at the end of the day, and Kramer said this publicly, it's not about being good, it's about being entertaining. So if you find a strategy, if you build a strategy that works, just rinse and repeat. I know so many people that all they do is tweak strategies and they stay where they are. They don't grow. Okay, there's 4 phases to building your trading plan. Number 1 is to write out all the rules. Sorry, this is about testing your trading plan. Be sure you have a trading plan in order to test it. Number 1, you pull up the stock chart and you just look for entries. Write out your rules and then look at charts. Go back in time, kind of like we did on Schlumberger, kind of like we just did with the 3 arrows rule. Just scan through your charts and find out when it would have triggered, where your stop would have been, where your target would have been. You want to do that, find at least 100, at least 100. And then do something called back testing. Back testing is where you look at a potential trade, candle by candle. I'm not good at doing multiple things at one time. So in this case, we might go back here and we're going to just look at this. And yeah, we are in bearish at this point. And we're going to look for when we get 3 green arrows in a row. And I'm clicking this button down here going candle by candle. Okay, I got an upturn in stochastics. That's 1. I got a close above the 10 moving average. That's 2. So if I get the MACD crossing 0 before I get a red arrow, then that's going to be a buy signal. Oop, I got a sell signal. So now I'm back to square one. Okay, 1 green arrow. I'm going up in the stochastics, so that's 2 green arrows. And boom, I got a buy signal. So I got a green arrow there. I've got the upturn back here. I got the close above the 10 moving average. That is a buy signal. So I get out my journal and I log that entry. Okay, that's back trading. The cool thing about chart trading in history is you can do a lot of that really fast. Back trading, you can also do a lot of it. It's a little bit slower. Stage 4 is paper trading. This is where you trade with fake money. Charles Schwab on Thinkorswim at that referral link I used will let you trade with real money, real stock prices, but it's just fake money. Not real money, it's paper trading. And then trade your strategy with a very small amount of money. I call it a small R. R is your risk unit, and it's usually a dollar amount. Sorry, it's not usually, it is a dollar amount. So a small R might be $50 for me, it might be $10 for you. But you want to log 100 trades of each of these 4 phases before you trade it with a full amount. Brad, that sounds like it's going to take a long time. Wow, yes, that will take a long time, depending on the trading strategy. But if you accelerate this, you will not have a statistically valid sample size to know if your trading plan will work over the long term. Okay, so an R is how much you risk on one trade. It's a dollar amount. If you're going to be trading a lot, you don't want it more than 2% of your trading account. It should be a non-emotional number. So for some of you, that's $1,000. For some of you, it's $50. Find what your R is where you are comfortable. It's typically the most amount you are willing to lose on any one trade and not have a bad day. It's the number of shares is going to equal your dollar amount divided by the entry minus the stop. So in this case, if your entry is at $50 and your protective stop is at $48, then your risk is $2 per share. So if you have a $200 R, that's 100 shares. If you have a $50 R, that's 25 shares. Then you set your target. I like 2R, right? So that means I'm going to win double on a trade what I might lose. That's asymmetric risk reward. So if my risk is $2, my reward's going to be $4. Maybe you like 3R. Maybe you like 2.5R. I've seen it all. The reason you need asymmetric risk reward is so that you don't have to be a 50% trader. Spoiler alert, when I was trading, I think I had over 3,000 trades. I had a 46% win ratio. So I lost more times than when I won. But when I won big. And when I lost small. And that's how I ended up winning in the long run. You need asymmetric risk reward. All right, here's the trade journal. Bijan posted it a while ago. Bijan, would you mind pasting it once again? If you want to go get a trade journal that I made for you, that I made before AI, which means there likely could be mistakes. Oh, where is it? I guess it's here. So the first tab that you'll come up on is a blank page. Write out your rules for your trading plan here. If you look at this drop down over here, you see H for historic. That's like going back through the charts. V for virtual. That's called back trading. R, little r for testing with a small amount of money. Big R when you're going live with real money. If you want to edit this list, first of all, hit File and make a copy so you have your own. Because as other people are clicking around on this, they can change the formulas. So verify the formulas. You can click this. These are all the strategies I use to day trade, swing trade, all the trades. You can change them over here. That's how you adjust, make it yours. The result, write down your trade evaluation. Is it a good trade or is it a bad trade? Guys, gals, please, for the love of God and all that's holy, a good trade is one where you follow your plan. A bad trade is where you did not follow your plan. If you follow the plan, if you follow your plan and you are not getting the results that you want, you can tweak your rules and then that will change your results. But if you get into a trade and then you get all emotional and you trade willy-nilly and you exit here and you take partials there and you do whatever you feel, it will be extraordinarily difficult to change that behavior. Get your mindset right. Follow the plan. One easy way to follow your plan is trade it 100 times historically, 100 times back trading, 100 times with fake money, and 100 times with a small amount of money before you get into big R's. Okay, if you've done it that much, you trust it, and you know how to do it, stick to your train. And then it does some formulas for you. Check the formulas, make sure that they work, because I am opening this up to lots of people, and y'all might be monkeying with my formulas. All right, enjoy that. I used to sell it. I think I was getting $500 for that. Also, if you have that and you come to the webinar, we can build on it together. All right, so this talks about going back in time and looking at the charts and finding where your entry conditions would have been met. And then according to your rules, would you have gotten stopped out or trailed out, or would you hit your target? And log everything as if it were a real trade. Then back test it, right? This is using the simulator. You can look up Thinkorswim. TradingView has an awesome simulator. Thinkorswim, though, you can do this for day trades, and I think it'll even tell you minute by minute what the stock did during the day. It'll have chart options data. You can go back years and years and see how the options change by the minute. It is an immense amount of data that you can back test using Thinkorswim. Oh, by the way, it's free. And then paper trading, again, you can do this in Thinkorswim, and you get real live market prices. They might be 20-minute delayed, but they're real prices. You cannot see into the future. You cannot cheat and see into the future. So you are forced to trade it blindly, only going by your rules and emotion if you allow yourself to do that. But again, you have no money at risk. And it is amazing. People tell me this, used to tell me this all the time back when I had the stock trading company, how even a small, insignificant amount of money changes the way you feel. And again, you must have a strong mental discipline to execute your trading plan because you are almost always hopeful or fearful when you are in a trade with real money. These are the formulas for expectancy. You can get these with AI. You can use AI to check the formulas that I put in that. But if you have a zero point 0.2 or better expectancy per trade, that's pretty good. That's pretty good. Why 100 trades? It's not even a statistically valid sample size. Guys, don't talk to me about statistics. I can get geeky. Um, but I've seen way too many people, they do 10 or 20. Sometimes they feel like they're flexing and they do 50. It's a drop in the bucket, folks. It's a drop in the bucket. Do 100. Do 100. All right, common mistakes that cause people to suck. Skipping phases, right? Some people just go straight to trading live money. That is speculating, also called gambling. Some people change the rules in the middle of a trade. You let your emotions get the better of you. Scaling up before consistency, again, that's opening you up to emotions. Some people get fearful or hopeful and they move their stop without rules. Skipping the log. Oh my gosh, folks. At first, the log's going to be painful. But once you have 100, 200, 1,000 trades in your log, it is so valuable to go back and see what has worked. Because maybe you go on a losing streak. I think maybe 12 trades in a row is the most I've ever lost. But if you are, trading in the thousands of trades, you can lose 12 times in a row and still be following your rules. And you need to be keeping a log to go back and look. Have I been changing? Have I been trading emotionally and didn't know it? If you can look at your log and your log says, yep, you followed your rules, it was just a bad set of luck and you know your expectancy, don't change anything. Keep doing it. Your luck will change. And again, I guess that's what this one is. Confusing a losing streak with a bad system. Your log is important. Okay, folks. Ooh, hitting an hour mark. The trading plan is crucial. Watch this video again. Build your trading plan. If you ask me for help, if you ask me, Brad, what should I do? I'm in on this. I will ask you, what does your trading plan say to do? And you need to have a trading plan. Money mindset determines your financial future. You got to work on your money mindset. When you're trading in the market, when you're trading in the real estate market, your mindset will be tested. You better have some discipline. Build it now. You need to calculate your desired rate of return, folks. Inflation is a bear. If you talk to your financial advisor, they'll show you some number 10 year, 20 year, 30 years in the future of what your money is going to become. It's almost always a big, sexy number, but you got to compare that to inflation. That's when I learned that my financial dreams were really a retirement dumpster fire. And I learned a different way to invest. I learned a way to invest where my investments are diversified, non-correlated with asymmetric risk reward, with the majority of it in real estate. Some in private equity. I want to get more private equity at the end of this year and early next year. Yes, I still have stocks that I trade. Um, I have some energy investments and I have some alternatives investments. Be sure your portfolio serves your needs for cash on cash and equity growth. Right now, I'm focusing on equity growth because I am not yet retired. When I am retired, I'm going to focus on cash on cash. We do have an investment now. Go to the website, schedule a meeting with Bijan or I, set a meeting on our calendars, and we will tell you about it. It is for accredited investors. Folks, by watching this video, by reading my slides, you will only get 10% of this skill. You will get the rest of it by discussing with others and doing it. And I had that vision came to me again. I'm going to do it maybe Q3, maybe Q4 this year, where I'm going to build a community where we can come together and we can build trading plans together. We can back trade together. We can test trading strategies together. We can look at apartment operating memorandum together and we can trade together. We can trade together. We can skip it, but we'll share all of our ideas because 10 people, 100 people hunting together are more powerful than an individual. Follow me on social media for more. And if you check the description of this video, you will see links for past videos. You will see links on how to register if you want to bring in your tribe to hear these sessions together. And yeah, there will also be information coming up on that webinar once I see if I can get us a group code where either we will all be in a breakout room together or discounts or what have you. So stay tuned. Questions, comments, type them in the chat pane. And otherwise, I'm going to go ahead and end the recording. So thanks for being here. And as always, trade on logic, not on hope. God bless you.